Everyone, I believe, should buy a home. It's the quickest way to wealth. It's tax beneficial. And so for all those reasons, it is my desire to help those who didn't think or didn't believe that they can acquire property. I want to prove them wrong. And that was my game plan, basically. I truly wanted to help. If you wanted to be helped, I was there to help you.
You really do help make an impact, a positive impact on people's lives.
Yep.
And they may be sitting there thinking they don't have enough money and they don't even know anything about down payment assistance programs.
Exactly.
And if they don't talk to a local mortgage broker, then
they won't know.
They never know.
Exactly.
Yeah.
That's absolutely the truth.
If somebody buys a home, their income doesn't change. You know, they bought it, they've got $100,000 of income a year, but they've got interest and property taxes that they can deduct at the end of the year. What do you have them do with their W-4s?
Oh.
Instead of getting a big refund, what do you have them do?
Yeah, they can actually.
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
Okay, everybody, we are back to another edition of The Blueprint. And today our special guest comes to you from Amerifund Home Loans. Angelina Garner is a very special lady. She's got some tremendous experience, not only in mortgages, but on the tax side of things, because she has a tax business too. So we're going to bring you a lot of information that's going to relate buying a home, owning a home, pulling cash out of your home, investing money, and how it also relates to keeping your income taxes as low as possible. So welcome, Angelina. Thanks for coming in today.
Thank you, Brad. I'm glad to be here.
Yeah, I'm so happy you're here. And one thing I didn't know, because I knew you were from Southern California, but I didn't know you permanently moved to Georgia. I thought you actually moved back here. So you flew in to visit with me.
Absolutely.
It's so awesome.
It's special, right?
It is special. I feel very special. We had the opportunity to meet in person about a month ago in Michigan at UWM, which was awesome. We had a long talk there. We talked about the things we're going to talk about today. But you bring so much value to your clients. And I really want to recognize that, because we talk a lot of times about accountants, CPAs, tax preparers, and how they become kind of the confidant for people to give them advice and help them through decision making, whether it's on investments or owning a home, or whether or not they should remodel a home and those things. And so I really want to relate that all back to, kind of some good, solid advice for people.
Sure.
What I really want to start, though, is how you got into the game, because you told me something that was kind of interesting. You said that you used to work for the California Franchise Tax Board.
That is absolutely true.
Yes. Brad. How many years did you do that?
I did it 20 years.
Oh, wow. Okay. So you worked a whole career. You got a pension. By the way, actually, let's drill down on that for a moment.
Yes.
Just because my mother-in-law just got something that was passed, I think, about 6 or 7 months ago. So my mother-in-law worked for the city, in my city in Simi Valley for, whatever it was, 30 years, had a pension. And because of the pension, her Social Security was reduced, like to some minimal amount.
Yes.
And she just got a lump sum check for, I think it was like 3 years of what she should have received for the last, I don't know, she'd been retired for 20 plus years.
Wow.
But they gave her a lump sum check for 3 years of what it was diminished and it shouldn't have been.
Wow.
Do you know anything about that?
No.
Okay.
But I do know how the pension affects your Social Security benefits.
Yeah. So there was something about this that was just changed.
Wow.
So look into it, because
maybe it impacts me.
It probably does impact you.
Yeah.
Because she's not the only one. When she got this notification and then she got this check in the mail, I spoke to some other people that were kind of the same thing. They'd retired, they'd had a pension, and they were, receiving Social Security, and they also got big checks in the mail. So, yeah, you may want to check into that.
I'm going to check into that.
Okay, there you go. So you revert back and let people know. But you worked for the Franchise Tax Board,
Yes.
and you were a tax collector.
Yes.
And you said something about you actually went house to house and knocked on doors?
Well, yes. Not arbitrarily, but the accounts that came across my desk where the taxpayer owed significant amount of monies and had not complied by paying it. It was my job as a tax collector to seize assets, to make contact with the taxpayer, and to convince them to take care of their tax liability. So that was part of my job. And then if they failed to comply voluntarily, then we had to take involuntary action.
Wow, I want to know what that is. But before we get there, that had to be scary sometimes.
Yes, it was scary. So I just created this game face. I decided that I would approach people with all sincerity of trying to actually help.
Yeah.
And that was my game plan, basically. I truly wanted to help. If you wanted to be helped, I was there to help you gain compliance so you can hang on to all your assets and not be impacted. And then there was a few people that took me upon that offer. And I felt really good about helping those people who truly have found themselves behind and not compliant and who wanted to really get out of that rut.
They just needed somebody to help
They
guide them
just
through
needed
it.
someone to give them the opportunity, to give them the resource, give them the information they needed to comply, and give them the time that they need to comply. And I was willing to do that as long as that taxpayer was able to show me effort, that there was true
That makes
effort.
sense.
Yeah.
So, all right. So let me ask you a question.
Sure.
So as a tax collector for the California State Franchise Tax Board that was responsible for collecting taxes and going and knocking on doors for this, what is the scariest or just most interesting story that you have from that experience?
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
I have one that still kind of haunts me. It wasn't that it was terrifying or scary, but it just showed how people in their thought process. I just can remember this lady who was suffering with cancer. And so it wasn't a personal contact. It wasn't a person-to-person contact. It was actually over the phone that she was angry with me for showing up at her home and recognizing the fact that she was suffering with cancer. And she blamed that whole ordeal on me. It's people like you, she said, that gave me cancer.
Oh, man.
Oh, my God. I don't know why that statement so much haunts me. I know it's not true.
Yeah.
It's not true, but for her to say those words to me actually had an impact.
Obviously, it had an impact.
Yeah,
You still remember it.
I still remember it very clearly, too. So I'm going to have to check that off my list because I don't know why it's so impactful. I remember it to this day, and I know it's not true.
Yeah. Well, I would have and it's not true, you know that, but I would have just thought, if you're knocking door to door and you're the tax collector and you're telling them I'm from the State Franchise Tax Board and they've gotten these invoices and bills and stressing them out, that there would have been somebody that really angry or had a weapon or maybe a pit bull they wanted to attack you or something.
Yes. I would have to say I have not encountered any dangerous moments such as that. There's been even times people were relieved at my presence.
Huh.
Can you believe that?
Totally different than I would have expected.
Exactly. They were kind of relieved that I came. And right there at their table, we came up with a plan of action.
Okay.
So those are the ones that are very memorable to me,
I think those should have more impact and more memory.
Yes, they were very memorable to me.
So obviously then you retired and you said you got into, you got trained to become a tax preparer. So this is kind of what I would call akin to you were a prosecutor and now you're a public defendant.
Exactly.
Right?
I like how you say that. That is absolutely the truth. I switch sides.
Yeah, you switch sides. This has got to feel a lot better.
It does.
Yeah, and you can still help the same people
yes.
that have a problem, but you're doing it in a different way.
Absolutely.
Okay.
You said it correct, Brad.
That makes sense, right, Micah?
Yes.
All right. So, all right. So you became a tax preparer, and
yes.
you said that just before that, and the reason you kind of got into this is you were also a signing agent. So you're doing notary for people that are getting loans. You're doing
yes.
their loan documents.
Yes.
And you're doing that on the side.
Yes.
Okay.
I was doing it as a side business.
And that is that's a business I think we should talk about for a minute because it's a business that most people don't think about, but it is a really impactful business.
Yeah.
And it can be very lucrative.
Yeah.
So as a notary who is a loan signing agent, so there's a difference. So, right, you've got to be a notary, you've got to be approved, and you've got to go through all the licensing to have that and the training and have your book and your stamp and all those things. But that's quite a bit different than being a loan signing agent because not only do you have to stamp you know, that they are the person that's signing and you're verifying all that sort of thing.
Right.
But you need to know those loan documents.
Yes.
And you need to be able to not necessarily explain them in detail, but
right.
at least explain what they are.
Yes.
And a lot of times you're encountering people that are reviewing their loan documents after they've been going through the process for 30 days and they are shocked or surprised at maybe it's the cost or the interest rate or something on those documents that they weren't prepared for. How do you handle that as a signing agent?
Well, there was one thing that I absolutely stressed to those individuals. I let them know that there is a clause that allows them rescission. There's a rescission period that is allowed to them. So they have time to go back, discuss it with their loan officer, and just rely on that. And then there's the period they can just cancel the loan if they're not satisfied with the outcome. So that was one of the things that I did. I did also make a strong effort to try to understand, give them some clarity what the terms said in the loan. But then there was also opportunities where it's like, oh yeah, that was quite, the terms didn't make sense.
Yeah, for their situation.
For their situation, or I thought that they might be correct in their assumptions and their thought process, and so I will agree. And then we'll take the time out, allow them the time to also contact that loan officer.
Yeah.
To discuss
it. And they may do it right then on the spot. Yes. But yeah, your goal is to get them to sign their loan documents and then hopefully get them to do some communication and so forth.
Yes.
But you know, when you have a client that doesn't sign, that actually it doesn't reflect well on you as a signing agent.
Yes.
It makes it difficult for you to get that next job.
Yes.
Yeah.
Yes. But I also learned in that process that really the companies that I associate myself to, because sometimes those companies are the ones that have these continual problems where the client is either left confused or what they discussed wasn't what the documents reflect. And I come quickly to learn that there's a problem at that company more so
you
than
could recognize
anything.
which were the good and which were the bad companies.
Yes.
That's true.
Yes.
That's true. So as a signing agent, because it's been a long time since I had originated a loan and was involved in the process of hiring a signing agent and so forth. But I know back when I was doing it, they would charge about $150. And typically would take an hour-ish, maybe a little bit longer than that. What do they charge now?
That's still about the rate.
Is it?
Yeah. Now, I need to also warn you, I've been out the game, too, about good 3 to 4 years now.
Okay.
But that's about the rate that I last remember.
Interesting. Okay.
And even cheaper.
Even less than that. Well, I know they have, so there are things called hybrid closings now.
Yeah.
Which means that you can sign online all the documents that don't need to be notarized.
Right.
And then just meet in person for those 6 or 7 documents that need a notary signature on it.
Right.
A signature that gets notarized.
Absolutely.
And then there's virtual closings. And the virtual closings are not allowed in California, of course.
Yes, of course.
There's several states that aren't, but of course we're not technically savvy enough here to do it. But in the areas that are allowed, they basically do everything online. And when it comes to those items that do get notarized, you do a video, right? It's a video.
Yep.
And then they sign in the presence, the video presence of that person who's validated their identity through sharing those documents and so forth while they're on the phone with or on a video call with them.
Yeah. That's pretty cool.
Yeah. It's definitely changed the game.
It's changed the game.
And it's a lot easier. Look, it used to be that you'd have to come in the office for a loan application and sit down, or I'd go out to the house and take it. And now that almost never happens, the face-to-face application. We send a link, they fill it out, we go back and forth on the phone a few times, and they've got their loan application in.
Yep.
So things evolve.
Yep.
And there's not as much business for the signing agents as there was. But if you think about, if you're a signing agent, you do 2 or 3 or maybe 4 signings in a day.
Yes.
And you're charging $150 a piece.
Right.
That's all your money.
Yes.
That's not a bad daily income.
It's not bad. But then when you also consider there's other expenses that notary do incur, you have to consider. Like, I found it to be highly expensive to run because of, especially if you're responsible for printing the documents.
That's a good point.
Yeah.
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 Yeah, you got to have a high capacity printer and all the ink and all that, because there are a lot of documents.
Yes.
And again, maybe not so much now with the hybrid
with the hybrid closing, that's a
but
game
then you
changer.
can't charge as much either.
Right, you can't charge as much. And then also the wear and tear on your car. That's another expense.
That's true.
Yeah, although it's highly expensive to run, when I compare it to my other services that I offer, such as tax return preparation services, I really loved it.
Yeah.
Yeah, I really loved it.
It gave you the opportunity to go out and meet new people.
Yes.
And be out and about, not be cooped
yes.
up. But yeah, even if you did, let's just say an average of 2 or 3 a day.
Yeah.
So let's say you made $400 a day, $450 a day.
That's pretty good.
I mean, yeah. Maybe you're not doing it every day of the week.
Yeah.
But if you're driving Uber or something, that would be a really good Uber day. And you're putting a lot more wear and tear on your car.
Yes.
Right?
Yes.
And you got strangers jumping in it. And
absolutely. You just have to be strategic.
Yeah.
Like, I had to learn my radius.
What you'd accept or not.
Yes.
Yeah.
Yes.
For sure.
Yes. As a newbie, of course, I think I accepted everything, and I just was going everywhere. But then I learned to tailor down and just accept assignments that were within a radius of my home.
Yeah, that makes sense. All right, so you got into taxes.
Yes.
You got educated on preparing taxes, and then you started your own firm.
Yes.
And as a tax preparer, here's what I find really interesting, because we do work with a lot of CPAs and tax preparers. You've got the insights with your customers to know their entire financial picture for the most part.
That's true.
You get to see their assets because you see the kind of interest they throw off, right? So what they have invested in the market,
right?
Or how much cash they've got in the bank and what kind of interest that's yielding or not yielding.
That's right.
You get to see if they've got mortgage interest they're writing off or not, if they've got property taxes they're writing off, if they have rental properties, or maybe they've got a really good W-2 wage job, and they're paying a lot in taxes.
Right.
When you see somebody like that, what kind of advice do you give them?
I'd say if you're considering joining the Amerifund team, it's a really good idea.
We as processors at Amerifund Home Loans support the loan officers in every aspect of the loan once it comes into processing, because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers.
If you're interested in joining the Amerifund team, go to amerifund.com/careers.
Well, let's take an individual that maybe is a wage earner who's earning over $100,000 in income, annual income. A couple of things, there's only so much you can do, especially when that individual is single. They are paying a lot in taxes.
Yeah.
So there's 2 things that come to mind that I recommend. Is that one is heavily contribute to a retirement account. the government is very generous when it comes to contributions to retirement account. You can actually reduce the amount of income and therefore pay less taxes. The other thing I like to buying assets, such as not any asset, but real estate property is a good one. Buying themselves a home that will offer them the opportunity to claim mortgage interests and also claim property taxes. And then also, as we discussed earlier, about the broker fees.
Yeah.
That is a tax deduction. And then also the interest that they may have paid in relation to that obtaining that loan, that is a tax deduction as well. So, but anyway, buying the asset that will continually allow them to allow other tax deductions is a great opportunity for people such as them that's earning a lot of money. But contributions to the retirement account, I can't stress that enough too. That's a great opportunity.
Yeah, you've got a little bit, some limits there depending, right? Because just a standard, like an IRA, a traditional IRA right now, what is it, $7,000 is the limit for the year?
Yeah, there is a limit to that. There's also income limitations too.
Right,
so,
and there's income limitations. Then you have to look at other solutions like a SEP, self-employed pension fund, and things like that. Well, let's talk about that just a moment, because I don't think people really realize what that means, a tax deduction for your retirement. So, for example, if you got somebody earning $100,000 in the year and they qualify for just a traditional IRA of $7,000, how does that work?
So their contributions, if they contribute out of pocket $7,000 of cash, let's just say it's cash, into a account that they set up with a bank, just a bank, but it has to be an individual retirement arrangement account. And if they set up that account and contribute that money to the account, it will translate a reduction of $7,000 to your $100,000 income. So now you only tax, instead of being taxed on $100,000, you are then taxed on $93,000.
Right. So if you're in, let's say, a tax bracket where you're paying on average 40 cents for every dollar, 40% tax bracket, then you're not paying that 40% on the $7,000 you put in your IRA account.
Absolutely.
And so that's a savings of like $3,000 in taxes that if you didn't invest that money, you're paying it to the government.
Right.
So instead of you paying $3,000 to the government,
absolutely,
you put $7,000 into an account of your own, as a savings, to take at retirement, which is what age?
59. 59 and a half.
59 and a half. So you got to leave it there, otherwise you can get a penalty, right? And then have to owe the taxes and all those things. But assume you're just putting it away there for your retirement.
Right.
59 and a half, then you can take it not tax-free,
right,
but penalty-free.
Penalty-free. That's a good point. Yes.
I think people make the mistake of thinking that you're going to pull it out tax-free, but it's not tax-free. It'll grow every year when you put it in there.
Yes.
But you can't take it out tax-free.
Right.
You're going to pay the taxes based on your bracket at that time.
Right.
Right?
Yeah.
Which at retirement hopefully is less than when you're a big wage earner.
Yeah.
So it's very impactful.
Yeah.
But now let's talk about the other side of it, which is owning a home.
Yeah.
So if you own a home, you get to write off the mortgage interest, okay? And there's a limit to that. What's the limit for mortgage interest deduction?
The limit is basically... There's no limit.
It's $1 million, isn't it? $1 million principal. Principal.
Right.
Right?
Yes.
Anything above that, you don't get the tax break.
Exactly.
Okay.
Exactly.
And
it has to be your personal residence, too.
On your primary residence,
primary
correct. It's handled differently on investment property.
Yeah.
So primary residence, up to $1 million.
But you can actually claim secondary homes, too.
And second homes.
Yeah.
Okay. Let's go back through it. So primary residence.
Yes.
Second home.
Yes.
Up to $1 million.
Right.
You can write off the interest.
Yes.
Okay.
Yes.
How does that work?
So what that does, that becomes a part of your itemized deductions. Every taxpayer has an option to either claim the standard deduction that the government allows to each taxpayer, or you can claim itemized deductions. And you will always only want to claim itemized deductions if they should, the total combined of it exceeds the standard deduction. Now, in calculating your itemized deductions, there are certain items that the government allows as a deduction, such as there's medical expenses, there's your real estate property taxes, there's even other property taxes like the property taxes on sales tax, let's say it like that, sales tax, there's your state taxes that you paid. Although there's limitations to that combined, there's a combined limitation of $10,000 for those taxes.
Okay.
And then there's the mortgage interest that you claim, and then there's charitable contributions. Now, I also want to make a note because a lot of people are confused about this, but 2017 created significant changes when it came to the itemized deductions. Remember how we used to can claim such things as union dues or tax return prep fees,
right,
investment fees. Those went away.
Okay.
And in 2017, the Tax Cuts and Jobs Act.
Okay.
So for the most part, we can still do the mortgage interest. We can do still state taxes and real property taxes and medical expenses and charitable contributions. All of those are considered itemized deductions combined together, and if it should exceed the standard deduction, great, and you should claim it.
Okay.
Yeah, and most of the times it has in years past that when you are a homeowner and then you claim that mortgage interest and the real estate taxes, it almost always exceeded the standard. However, with like I said, the standard, the 2017 changes in the tax laws, sometimes it does and sometimes it doesn't.
Okay, so you do the analysis as the tax preparer, but assuming that it does, and let's just say, for example, it's the same thing, the same way you look at it as the traditional IRA that we talked about.
Right.
So if you've got mortgage interest, let's say for the year, and that mortgage interest was $10,000 that you paid in mortgage interest. Now, we're not talking about your actual mortgage payment. Most payments are principal and interest.
Right.
But you'll get a statement at 1098 at the end of the year. For your mortgage interest.
Right.
And let's say that that's $10,000. And again, using that same scenario, if your income's $100,000 a year and you're in a 40% tax bracket, and we're talking about, federal and state, then you can reduce your income by that $10,000 and therefore save that 40% or $4,000 of taxes that you'd otherwise pay.
Yeah.
Right?
Right.
So is that...
Well, I want to explain a little different because, like I was explaining the difference between a standard and itemized deduction. See, it would have to be, okay, say for example, we're talking about an individual. Their standard deduction is about, oh goodness, I think it's $16,000 for this year, for the 2024 tax year. So when you say $10,000 of interest, let's add in other, and then let's just say the property, and then the taxes are $10,000. So $20,000. So that $20,000.
All right, I chose too low of a number.
Yeah.
Okay, I got you. And $10,000 would be like you're buying a very small home in rural upstate Indiana or something. So
low interest rates though too. The low interest rates creates that.
Okay, so let's reiterate this.
So like $20,000 will reduce.
It reduces your income. So instead of you claiming $100,000 of income, you're claiming $80,000, which means on that $20,000, if you're in a 40% tax bracket, you've now saved $8,000 in taxes that you'd otherwise pay.
Yeah.
So when people are looking at affordability, okay. Here's what I like to say. If you're going to pay rent, let's just say, for example, the rent is $3,000 a month, right? And that money is just gone.
It's gone.
Is there even a rental deduction anymore of like $150 or something?
The state of California does offer it,
yeah, it's like
but
minimal.
It's so limited.
It's like almost nothing.
Almost nobody qualifies for it. You have to make income about anything $35,000.
Yeah,
is the income limit.
So it's almost nothing.
It's almost nothing.
So let's say you're spending $3,000 a month for rent.
Yes.
If you went and you bought a house, and your mortgage payment was $4,500 a month.
Yes.
And of that $4,500, you had $3,700 of interest. That portion of it. Then you take your tax whatever tax range you're in, if you're in the bracket where if you're 37% or 40%, whatever it is, 40% of that $3,700 every single month is money you save in paying income tax on.
Absolutely.
That's powerful.
It's more.
So even though your payment is $4,500 a month, effectively it's way less. It might be the same that you're paying for rent, $3,000 a month.
Yep.
But you're gaining an asset.
You gain an asset that appreciates.
That appreciates.
That's
over
why
time.
I love real estate.
Yeah. So you get to write off the mortgage interest. You get to write off the property taxes.
Absolutely.
Those are 2 deductions. When you're paying for a mortgage, you want to give your closing statement, whether it's a purchase or a refinance, to your tax preparer.
Right.
Because you're going to look for a couple of things in there. What are those things you look for?
Some things are like the broker fees and the title fees that are associated to the title is some of the fees that are tax deductible.
I didn't know title was.
Yeah.
Oh, okay.
Yeah, there's
and when
some
you say
fees
broker fees,
associated.
is it just discount or is it also origination?
It's actually the origination fees.
The origination?
Yes.
Okay.
Yes.
That was my understanding that discount fees, because they're buying the interest rate down, it's prepaid interest.
Yeah, exactly. And that's how that's treated.
Okay.
Right.
So you get to do that.
True. Yeah.
So now, do you write it off at the time of purchase, or do you have to wait until your next transaction to write those items off?
At the time of purchase. Well, if it incurs within the tax year, you can write it off once you go to prepare your tax return.
Okay. Because my understanding that on the discount fees, if you're buying the rate down, that it's prorated over the term of the loan.
Oh.
Is that true?
That is true.
Okay.
Yeah.
And then so whatever you hadn't written off, if you go to refinance or sell, then at the time that transaction completes, you get to write off the balance of it.
That's right.
Is that true?
Yeah,
Okay.
that's true.
All right.
Yeah.
Yeah. Some of these things have changed over time.
Yes.
So I'm not super familiar with it.
I know.
But that's my ancient understanding of it anyway. And then you've got investment property. So you've got you're doing your taxes for people and you're seeing that maybe they've got a lot of cash and they could use another tax shelter or something. What is the analysis you go through to say you may want to consider buying a rental property?
Well, if they are, say for instance, those individuals too that we were talking about earlier, they have high income and no tax benefits
Shelters.
whatsoever, they make a good candidate to purchase an investment property. I actually would recommend those individuals to buy something in which they can live in, like a duplex, particularly. They can live in and rent the other. I think that would be a great opportunity.
I always say
for
that that's really
individuals.
powerful.
Yeah.
To be able to do that, even a triplex or a quad.
Yeah, even triplex.
Which I know in Georgia there are a lot more of those than there are in Southern California.
Yes.
Not easy to come by.
That's easy to come. Yeah, Georgia has some. That's the property. That's where I need to be.
Yeah. But you're right. You get the benefit of your primary residence for the unit you're living in.
Absolutely.
And you get the benefit of investment property for the other residents. And that interest is handled differently for those, isn't it?
Yes, because investment properties actually is considered passive income, and it does have its own different tax rules associated to it. Like, for example, you're limited in when it comes to writing off any losses. You're very limited there.
You file a Schedule E?
Yeah, you file Schedule E.
So Schedule E for rental properties.
Yes.
And then you keep track of your expenses.
Yes.
Right? And then your revenue.
Yes.
So your revenue being the rent that you charge, and then your expenses could be property management fees. It could be interest, taxes.
Utilities.
Could be utilities. It could be, repairs.
It could be even your time, not your time, but the drive. The travel.
Oh, interesting. So there's some travel.
Yeah.
You can deduct some mileage, maybe, and that sort of thing. And so it takes your revenue of that property, all the expenses, and you're saying that there's... So what I like to recommend is that people try to break even on those.
Yes.
And so if you're carrying such a low loan amount or you're owning the property outright and it's all income, you're paying regular taxes on that income, right?
Yeah.
And that adds up.
Yeah.
But if you tap into the equity and you pull the equity out
yeah.
and you get the cash, you don't pay tax on that cash out loan.
That's true.
And then you break even
right. You have
on
a
your
mortgage.
taxes.
Mm-hmm.
So you're not claiming income that you're paying revenue on, but you're also not getting the benefit of negative, right?
Yes.
Because you don't get all that benefit if you're negative.
That's true. But you said it best when you say it's always best to break even.
Yeah.
Yeah, because the passive losses and the passive income, you don't want that in your life.
Yeah, because the passive income you're paying regular income tax on, right?
Absolutely.
It's the same. It's the same amount.
It's the same amount.
Yeah.
Yeah.
That's a lot.
It's a lot.
Okay.
Well, at least you're not subjected to self-employment tax. We don't even talk about that.
Let's talk about that. I don't know much about it. I think people would be interested. Tell us about self-employment tax.
Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show.
I think people would be interested. Tell us about self-employment tax.
Well, self-employment tax is interesting. It's an interesting animal. It's a tax that individuals that are self-employed, say for the Schedule C that is created through your taxes.
Is there still a Schedule C?
Yeah.
Oh, okay.
There still is. Generally for those LLCs or sole proprietors.
Okay.
So Schedule C come into play. So all the business income is reported along with all the related business expenses. So the business income, after considering all the expenses that you incurred and deducting, you are taxed on the business income, the net business income, I should say, and you are assessed a tax of, I want to say either 12.3 or 15.3, which is considered self-employment tax. That's not on your ordinary income. That's only on the net business income. But I like to remind people this, and this is a great avenue to share this, that the self-employment tax is actually your money. It's a contribution towards your Social Security and your Medicare.
Oh, okay.
So that's important information because it is really your money in which you can track going to the that you should track by going to the Social Security website and making sure that money is documented under your account.
That's great information. I had no idea.
Yeah.
So is this why people that are self-employed, like over COVID, they could claim unemployment because they were contributing through the self-employment tax?
Yeah.
Okay.
Yeah.
I got
absolutely.
it.
Yeah.
Okay, I didn't realize that.
So I know it's a pain in the butt to have to pay, because it's anything that you make, you're going to be assessed that tax.
Okay.
As a self-employed individual.
Got it. But it is going into your benefits.
It's for your benefit.
All right. So you're reviewing somebody's tax returns. You're realizing that they're maybe making a lot of money, but they don't have any tax shelters.
Mm-hmm.
Of course, number one, you recommend that they buy a primary residence.
Mm-hmm.
Alternatively, to buy a primary residence, it has some investment aspect to it, like
mm-hmm.
a duplex or a triplex or a quad,
mm-hmm.
To get into those properties. So now you're going through, you're helping people, you're advising them
mm-hmm.
On some real estate needs.
Mm-hmm.
So it interested you, based on your exposure as a signing agent, to actually get your license
mm-hmm.
and also become a loan officer.
Mm-hmm. It did. From being a loan signing agent, and then given you said it perfectly, my exposure, my experiences, it just made a lot of sense for me to transcend into a loan officer, a mortgage loan officer. I love numbers. I love balancing numbers.
Yeah.
And I love the opportunity to help others acquire home ownership. I think it's important that we tap into that. Everyone, I believe, should buy a home. It's the quickest way to wealth.
Yeah.
It just does something for your family dynamics. It creates wealth. It provides stability. It's tax beneficial.
Yep.
And so for all those reasons, it is my desire to help those who didn't think or didn't believe that they can acquire property. I want to prove them wrong.
Well, it's interesting because most millionaires are created through owning real estate.
Yes.
And it is the quickest path to becoming a millionaire.
Yes.
Even if you just have a primary residence. And we look at just over, somebody's lifetime of the 20 or 30 years of home ownership. And you look at historically what the values of properties are. They've gone up every single year with the exception of about 6 years in the last 30 years.
Yes.
And of course, we're higher than they were back when they went and fell in those 6 years. But only 6 out of the last 30 years have homes declined in value.
Absolutely.
So the people that advise people to just rent and not buy homes, it's a real disservice.
I think it is too.
Yeah.
I don't even know. I don't have a reason to even suggest to rent. I just don't understand it.
Yeah. Well, here's something I tell people all the time because a lot of people don't think that they can buy. And it may be related to them not having perfect credit.
Exactly.
Or they don't have a lot saved up yet. Or they sincerely just don't know where to start or how to do it.
Exactly.
What I always recommend is talk to a mortgage broker.
Yes.
Not a bank.
Yes.
Not somebody that works at a large lender,
Absolutely.
not a Rocket or anything like that, because those people sit behind a desk and believe me,
Yes.
they really don't care. If you don't qualify, they're moving on to the next call.
Absolutely.
But if you get a hold of a mortgage broker
Yes.
who's 100% commission,
Yes.
meaning they don't get a dime, they don't earn anything until they
Yes.
close your loan.
Absolutely.
What do? They're crafty. They figure out a way.
Yes.
And if they can't do it today,
Yes.
then maybe it's a month from now, maybe it's 6 months from now, maybe it's a year from now.
Yep.
But they become your best friend and they work with you to get you in a position to buy a home.
Yep.
So if you really want to buy something, you got to reach out to somebody like Angelina, who also has the benefit of the tax knowledge as well, which is tremendous. But you're going to be focused on getting them in a home,
Absolutely.
no matter how long it takes.
Absolutely.
Yeah.
In fact, that is my objective. I would love the opportunity to meet someone who has that mindset, who probably has the income, but yet just don't think that they could ever acquire property. They don't have what it takes to acquire the property. I would love to sit down with them, to educate them, to help them to set goals, to create a plan of action, and then ultimately leading them to home ownership.
It's so good.
I think it would be so great.
Yeah, it's so good. That's one of the benefits we have of doing what we do because you really do help make an impact, a positive impact on people's lives.
Yep.
And they may be sitting there thinking they don't have enough money.
Yep.
And they don't even know anything about down payment assistance programs.
Exactly.
And there's a lot of those out there.
There's a lot of them.
And they are, some of those are forgivable, meaning that you get the assistance, the 3 or 5% down to help you with that. But then after a couple of years, it's forgiven. And so it's free money.
Absolutely.
And if they don't talk to a local mortgage broker, then
they won't know.
They never know.
Exactly.
Yeah.
That's absolutely the truth.
Yeah. So we've talked about the tax benefits of owning a home. You've got your property taxes, you've got your interest, and other deductions that you can take that's going to save you on your mortgage payments, because it is a direct reflection on that.
Yes.
If somebody buys a home and their income doesn't change, they bought it, they've got $100,000 of income a year, and this could be their own or it could be them and their spouse, but they're making $100,000 a year, and they buy the home, and their mortgage payment is, whatever. Let's go with what we had before, $4,500 a month. But they've got interest and property taxes that they can deduct at the end of the year. What do you have them do with their W-4s?
Oh. And so, and ultimately, they are getting a refund back, right? Is that what you're saying?
Instead of getting a big refund, what do you have them do?
Yeah, they can actually increase their W-4 so that they can monthly see their money and pay less taxes.
That's right.
Yeah.
So let's repeat that so people understand.
Yeah, that's a good one,
you
Brad.
buy a house, and you're going to get these deductions for interest and for property taxes and other things. So at the end of the year, if you do nothing, you're going to get a large refund. because you have these deductions, you need to take advantage of them.
Right.
But rather than get a large refund and let the government sit on your money
Absolutely.
all year long,
Absolutely.
you change your deductions, you
Yes.
take more deductions,
Yes.
so that your net paycheck
Yes.
is higher, meaning they're taking less out of your paychecks.
Yes.
That helps you make your mortgage payment every month.
Absolutely.
Instead of getting a big check at the end of the year, you're getting it every single month and helping make those payments. So the impact of that $4,500 a month is less because you got more money on your paycheck to make the payment.
Absolutely.
Yeah.
And I think that also come into the mindset. I think some people have been conditioned to always expect this large sum tax refund. That also come with the home ownership. That change in mindset has to come as well.
Yeah.
Yeah,
I think you're right. People think of a tax refund as like a piggy bank.
Yes.
And then they get the refund
Yes.
and they're like, yahoo! And they go out and they go shopping or whatever it is, and they count on that every year.
Yes.
But all you've really done is you've given the government the ability to use your money all year long instead
Tax-free.
of yourself. Tax-free. They don't pay interest.
They don't pay you no interest on that.
Yeah, they don't pay you interest, so take the money.
Yes.
Monthly. So this is something that when you meet with your tax preparer, you want to say, am I taking the right number of deductions?
Yes.
Your goal should be to break even at the end of the year.
Absolutely.
Not owe anything
Not,
and not get a refund.
Absolutely.
That should be your goal.
Yep.
And when you buy a house,
Yep.
you really need to recalculate this because otherwise you're going to get a large refund at the end of the year. Why struggle all year round when you have more on your net paycheck to make those payments?
Absolutely.
Yeah.
To make those payments
Does that make sense to you?
are contributing the difference into an account that can earn you interest.
And yeah, you can use that money for investment purposes. If you don't need it every month, then fine. Great. Use it and create an investment. Yeah. Now's a great time to get in the stock market. Yeah.
I know. I'm trying to figure out which stocks to buy.
Well, there's a lot of choices today because the stocks are very low. And so just about any entry point today will mean a big return in the next 5 to 10 years.
Yes, absolutely.
So, what else do you want to talk about, Angelina?
Well, let's chat about the mortgage loan. I'd like to ask you a question.
Sure.
The state of the current industry, what do you think overall?
Yeah, things are changing rapidly.
Yeah.
They're changing rapidly for real estate. They're changing rapidly for mortgage. So let me paint a picture for you.
Okay.
All right. So let's go down memory lane. So when I started in the business in the 90s, things were very manual. Okay. We took a handwritten loan application. We'd have to press through 8 pages so that it could duplicate, right? We would go out to people's homes to do the loan applications. We'd gather all their documents, take it back to the office, copy them. By the way, not even with a feeder, like where it feeds into the machine and does it rapidly.
Right.
One by one by one. Then I'd have to meet with them to deliver their originals back to them.
Yeah.
Their tax returns, their W-2s, all of that. We didn't have cameras on our phones. So the ID, they had to bring their ID in so we could take a photocopy of their ID. All of that obviously has evolved, and it's evolved rapidly. But I think we're going through an even more rapid change in the business. AI is having an effect on that. So right now today, you can do your loan application virtually. You get a link. You fill out the application. There's not even that many fields to fill out anymore. You can connect your bank accounts to the application securely, so that you don't even need to provide bank statements. It just gets that information online. You can connect your income the same exact way if your employer subscribes to some of these services. You don't have to provide pay stubs. You can do the same with your tax returns, connect to the IRS so that we don't have to gather those. So really, you can have a complete loan application all connected and be approved on a loan in a matter of minutes. And there are companies out there that are really making this easy for borrowers. Now, it doesn't apply in every situation. You got to be pretty cookie cutter to do all those sorts of things.
Absolutely.
And most people aren't. Most people need a little massaging. Maybe they don't show enough income here, or they take too many write-offs there, or they're a little bruised on their credit, and so they need a professional to help them kind of guide them through that and do the right thing and provide the right information, because if you provide the wrong information, you get a loan declined.
Right.
But for the ones that are very cookie cutter, that meet all the criteria to make it really easy to have an underwriting decision, they're going to move through the system very quickly, and they're going to be the lenders that are going to provide that personal loan. They're going to be a commodity. It's all going to be about how quick you can deliver it at the lowest rate.
Right.
Okay, that's about 20% of the business. It's not the largest amount, but it's about 20%. That's changing rapidly. At the same time, real estate's changing. So last year, we came out of a year with all these lawsuits. The lawsuits were about real estate commissions, and big judgments and settlements where NAR, National Association of Realtors, had a very large settlement, and it affected change in real estate. Change to the point where now there's a decoupling of commissions. So instead of the seller creating a contract with the listing agent agreeing to pay a fee to the buyer's agent through that one contract, the buyer has to contract separately with their agent, and the seller has to contract separately. So the seller now says, you're my agent, I agree to pay you X amount. The buyer then has to agree, if they're going to use a buyer's agent, to pay them their fee, but then hope to negotiate when they write the offer for the seller to help them pay for that fee, right? So it's a little bit different.
Wow.
Some sellers may just say, no, I don't want to help you.
Right.
Others will look at it more practically in that, okay, well, if I'm going to help you pay 2.5% to your real estate agent, then I want 2.5% more on the purchase price, right? They're just going to look at what they net.
Yeah.
This is all going to depend on the agents that are advising them, that are being very practical about this.
Exactly.
But there are some sellers that have basically blanketly said, I'm not paying a buyer's agent commission. You want to hire an agent, you pay for it themselves. It's limiting. So that's changing rapidly. At the same time, we've got this idea of clear cooperation. And we're neck deep in this right now. Clear cooperation is where the MLS says, and NAR says, that you have to, within 24 hours of taking a listing agreement, you have to put that loan in the public domain. When you do that, when you put it on the MLS, it becomes part of the public domain. That feed of that information sends out to all the major portals and sites like Zillow, Redfin, Realtor.com, Homes.com, and all the other sites.
Yeah.
Well, there's been a big fight against this, as you can imagine.
Yeah.
Because the real estate companies are getting squeezed. They're used to having a certain percentage of their income based on buyer side transactions and a certain percentage on seller. And some of those are getting both on the same transaction. Well, if buyers are opting not to contract directly with buyers' agents because they're afraid of having to be stuck with that fee, these companies, Compass being the leading one, are saying, well, we're going to find a way to increase our income by housing just these listings in our own portal and not putting them out on Zillow so we lose them, not putting them out on these other sites so that we don't have control over them anymore. So they've been fighting this idea of clear cooperation.
Oh, wow.
And just recently, there was a change. And the change said, you can take a week to put it on. Well, here's what's happened. Here's what's interesting. When that happened, Zillow said, okay, you're going to try to restrict the number of properties that we have on our portal. Well, then if you do that and you don't put your listing, Mr. Listing Agent, on the MLS right away so it populates into our site, well, then you can never put it on our site. So if you have this listing, then you have to tell your seller, hey, by the way, we want to just market your listing in our portal. And if we do it this way, then you may never wind up on Zillow. And Redfin did the same thing. So you may never wind up on, and so Zillow has 85% of the buyer traffic. If you're a seller, wouldn't you want the exposure of your property on Zillow?
Absolutely.
You want as many people looking at your house for sale as possible.
Absolutely.
Now, there's a small segment of people that want the privacy. They just want to sell on the side. They don't want a for sale sign.
Yeah.
They don't want their neighbors to know that they're selling.
Yeah.
They just want to be private about it. Well, there's always been an option for them not to syndicate their listings and not to put it out there. But now there's this battle going on.
Yes.
And this battle is happening as we speak.
Wow.
So when we talk about change being effectuated, major change is happening to the point that I think a lot of this gets picked up by artificial intelligence.
Oh, really?
That as a buyer, you're going to put yourself in a position where maybe you don't need an agent. Maybe you've got an artificial agent who's better at scouring the market, who's better at delivering to you just those properties you might be interested in because they learn about you, and they are perfect at seeing what else is out there. The fragmentation of listings being here or there and everywhere, that's going back to old times. Like that's the way it used to be. So it becomes more and more difficult for people to operate in this environment where they don't get all the listings in one feed. So yeah, things are changing a lot.
Wow.
You got it. You have to be working with a professional today. Like that is an absolute must. If you're not working with a loan officer that's a broker that's being paid 100% commission to close your loan, you're selling yourself short. Because they are highly motivated. If you become a commodity, and you work with a with a large company that just has a call center, you're not going to get this kind of advice. You're not going to get the information you need to make the right decisions through this crazy changing time in real estate. So, anyway.
And I hear you actually supporting the professional, but do you sense that in the consumer market there's a push away from the professional or seeking professional and the consumer trying to accomplish it on their own?
Yeah, I do. I see DIY, that society growing quite a bit. And the people that don't see that are just in denial. And I think they're going to find out very quickly. Look, we've gone just in the mortgage industry. In the last 2.5 years, we've lost 300,000 licensees. We're down to 93,000 licensees from over 400.
That's a lot.
That's a lot. And real estate's seen the same thing. Real estate agents that have been, working and doing maybe one transaction a year, or maybe none, or maybe just a couple. And then every time they do a transaction, they have to kind of relearn it. They don't really know it. They're going away. You're good agents that are busy, that are professionals, that really know what they're doing. They're doing way more business and getting paid more than what they used to. So the divide, the delta between the two is tremendous. And it's happening on both sides, on the mortgage side and the real estate side. So I think we wind up with a smaller group of more highly professional licensees for mortgage and real estate moving forward.
I think that's good. I always thought the market was very highly saturated with real estate agents. That was one reason why I did not want to become one.
I agree. Look, I think your good agents would say the same thing. Because I just know, I know a handful of really good real estate agents, and they get frustrated by these agents that come in and they do their 1 or 2 transactions a year, and they don't call people back. And you write an offer and they lose it. They said they never got it. They have to keep calling and hounding them, and they just don't know what they're doing. And then they get in the way of the transaction. So they don't know how to calm their clients down, and they stir it up and they make it more difficult. And transactions fall apart when you've got that kind of stress going on. And so I do agree with you. I think that it's good that the agent of change is good, and that it's been way too easy for people to get a real estate license and say that they're a real estate agent, and the barrier to entry has to be a little bit higher.
You mentioned we're talking about real estate agents, but I see the same mentality in tax preparer. You have those tax preparers who come in just for the season, disappear. Poor taxpayers don't know what to do. They lost when a situation arises. So it's the same thing. Or they don't know the complete ins and outs of taxes and preparation. It's just certain types of clients that they truly deal with, which is those easy ones. And not the complicated ones. And so,
I'm sure that you see that all the time. In comparison, you may see a new client's tax returns, and you look at it and go, holy smokes, they missed all these deductions you should, and you paid way more taxes, and you have to go back and you have to amend their tax returns, which, number one, costs them money because you have to pay for the amended returns to be prepared. And number two, it increases their chance of an audit, right?
Yes.
And it pushes forward the time frame too.
Yes.
And so it's a disservice to them for people to come in and just, be these tax preparer hacks.
Yes.
That really don't. They're almost better off with like a TurboTax.
Yes.
As long as you feed it all the information, it's at least going to figure out what you're maximizing your tax deductions.
Absolutely.
So I think we're experiencing that there too.
Yeah.
So
that's true.
Angelina, this was awesome.
Yeah.
You have a plethora of information, and your clients are lucky to work with you.
Thank you.
If somebody wants to reach you, how would they reach out?
Okay. One of the best ways to reach me is to contact me at 866-272-6500. Or you can reach me by email, and my email address is angelina.garner@amerifund.com.
Yep, that's correct. And it's Garner.
That's correct.
Yep, awesome. Well, thanks again for joining me today and for flying out.
Yes.
This was a lot of fun. And Micah, I think we got some really... Right? You learned a lot today, didn't you? Yeah, we got a lot of great information. So thanks for joining. Guys, once again, thanks for joining us on The Blueprint. If I brought you value, if Angelina brought you value today, if you learned something, like, subscribe, follow, share, all those things really help us. And we'll see you next time on The Blueprint.